All right, everybody. I hope you're doing very, very well. We're going to kick this off as we always do, and we'll bring out the George Clooney shirt to show the importance and the severity of the situation. Here we are with the markets. It is April 16th, a Thursday, and I hope everybody's doing well. Welcome to the Morning BRRR. I'm Garrett Baldwin. If you don't know me, get to know me. It's a good time. We're having a good time. We're having fun because that's what this is supposed to be. And I want to remind you of that. It's been a little bit tense because, once again, had a little bit of a data issue that I had to work through. But this is supposed to be fun. So we're going to make it fun because markets are fun. They are the story of the world. And we get to get up each day and talk about this each day and go from there. Love this headline. The market, Mr. Market is off the meds, and it feels like it. You had make sense of a 10% move in 11 days. I'm going to walk you through exactly what happened, why the S&P 500 is above 7,000. Just give you a little bit of a guide here because a lot of this has to do really with mechanics of the market more than any optimism or anything built around President Trump. This, at the end of the day, is a flow issue, and it all really kind of kicked in right around the time that we saw a green move back April 7th, April 8th on poor man momentum and on our cap weight that we have with Money Printer Pro. Now, sometimes I'm going to doubt the rally. Other times I'm going to doubt the rally and the market's going to be right. And the market usually can and will be right. And that's how we end up in the situation where people feel late. So let me walk you through what happened. And you're never going to unsee this again. And that's the important thing because don't worry. We're going to have another one of these. We've been doing it every year since 2020. It's kind of how it works. And then people will turn around and say, well, it's not a bear market. Well, no, and there's no bull market or bear market anymore, is there? It's just liquid or illiquid markets. Ah, look at that dog having a good time. That's fantastic. This morning, jobless claims, Philly Fed, industrial production at 8:30, 9:15. You're going to get some capacity utilization updates. I know you're really pining for that. Earnings, we got Netflix, Abbott, Schwab, Pepsi, and Netflix opening with the big tech EPS number. Pepsi's consumer cyclical and a GLP-1 status, right? People drinking Pepsi anymore? Or are they just taking GLP-1s, drinking water, and sitting on the couch, claiming they worked out? Hey, we'll watch Schwab with retail flows as well. The Fed, we have Williams talking, who is a voter. We have Moran, who is a dovish dissenter. Again, we're going to get into the debate about whether or not there should be a rate cut or not. You got me. Thursday open, here we sit. S&P 500 all-time. Nikkei all-time. NASDAQ 26,420. Hey, feels.com to party like it's 2000. Russell pushing to 2728. Signal went positive on the Russell on the 6th of April, and I shook my head because 2 days before it was highly negative, and we had a big flow move that transpired really coming out of March 30th, but it was a big weekly move, and that's what we have to pay very close attention to are those weekly moves and the number of stocks that aren't breaking down anymore as capital started to flow in a very lower volume squeeze that started around the 30th of March and then really kicked in with that headline, the OIOU and the bond market signaling a squeeze on April 6th. All right. The DXY is under 98. That's important because of collateral quality internationally. Bond markets obviously hovering in the gold. Bitcoin currently sitting at 75,000, showcasing that there's money, there's leverage, and there's people chasing this after it kind of found its floor in that $65,000, $66,000 range. That technically feels like a floor for Bitcoin, given the sheer amount of passive flows in the ETFs that have been building for the last 2 years. And gold at 48.42. We have been bullish on silver largely since it hit in the mid 60s, upper 60s, selling put spreads on names like FSM, highly recommending that we anticipate silver continuing to move higher. We saw big sell-off transpire back around January 30th, 2 days after our signal went negative on momentum. That was leverage. Leverage completely pulled money out of this market, and a significant sell-off in futures due to the leverage impact on ETFs and those flows. And why does that matter? Because it kind of feels like a reset. If you look at the way that silver has moved, and we've been bullish on silver since it was at 25 in early 2024, March 2024, for the original Hedge of Tomorrow article. If it would have gone from 24 to where it sits now at 79, everybody would go, oh, wow, it's gone up 200% in 2 years, 2.5 years. Hey, and everybody would be happy. But because of that move all the way up to 120 and a pullback down to 80, people are now skittish because it's been, 33% down from all-time highs. And our message here is buy the dip. Just continue to focus on silver and gold, largely because monetization is going to continue. And of course, the idea that monetary expansion will be always here and will continue into the future. If you are nervous about that, sell spreads, sell puts, pick a price that you're content to buy gold miners with, silver miners with as well. Yes, if there is a contraction in liquidity, which we still do anticipate, these things will pull back a little bit, but they will reprice if and when the monetization and the ongoing printing by central banks, printing, whatever operations they call it, continue. 7,000 is the number, closing above that for the first time. January high was 69.78, the old record. We did see a little bit of a push above 7,000. We pulled back to 63.68, that war sell-off trough, really driven by significant amounts of institutional selling. And we're going to talk about what that meant and how it happened. Yesterday, we smashed through that level cleanly. The NASDAQ, 10 straight days green, which once again doesn't happen very often, really ever. So once again, this is more of an institutional flow element, and I'm going to lay that out in a minute to really give you a better sense and understanding of how this market rally transpired. The autopsy is relatively simplistic. I wrote a piece about this yesterday, and even if you are not a member of Money Printer Pro, or even if you're not following our signals, and if you're following our signals and you want to have a quick look at it, this is where we sit this morning. We had to do some updating to part of our data set, but that's kind of the way that things operate in the world of coding. S&P 500 plus 60 on our reading, cap weight 189, the Russell at plus 54. And as you can see, this is where it went positive back here around the 4th, 5th, 6th. That cap weighting, meaning larger cap stocks on the Russell, is what pulled it higher, and it has been moving higher since. The NASDAQ number we have fixed, so this is the first time we've actually been able to use this. And the S&P 500 extraordinarily strong. And I'm going to just simply note the strength of this move, this cap, is the strongest that we have seen in 2 years at this point. This is stronger than where we were at those peaks in January. And this is why you're going to see a number of banks are now saying to fade this rally. We're at a stronger point than we were before that sell-off started in January. So January 12th was really kind of the peak in momentum. We were at another point, a very high point in late October before we started to have problems in the credit markets tied to Japan and repo. So we are very, very stretched right now. But if you're not following this and you didn't get a chance, read this article. It's called Autopsy of a Market Rally. I released it yesterday. And why is it relevant? It lays out what the entire process looks like. And the process, if you're not following us, you don't have to, but there's a couple of things that you can look at. First off, quick shout out to the Whispering Candle for pointing the obvious out, the NFCI inflection. So that is the National Financial Conditions Index. It's released by the Federal Reserve of Chicago, and it was tightening, right? So if you look at the NFCI and you compare it to the S&P 500, it's kind of looks the same, just inversed. And it signals to me that the markets are largely focusing on liquidity expectations. That inflection point was signaling a shift in expectations and liquidity. Now we have to find out where that is coming from. It could be a weaker dollar. It could be some sort of monetary action by Japan and the United States. I just don't know. On March 30th, we did see an increase in insider buying. The spike for the year was in the number of buying forms, not dollar to dollar. I'm always looking for dollar to dollar. How much money, not how many forms. But it was statistically significant. It was the largest amount of insider buying in forms since December. That said, it wasn't the type of thing that really gives me a lot of confidence that the worst is over or that there may be another, whipsaw effect like we've seen in recent months going all the way back to November. The RSI hit oversold on the S&P 500 on April 2nd, which was my birthday. Hey, very exciting. Congratulations to me. Here you can see that RSI move right here. RSI at under 30 at oversold. This is significant because we had a move where we squeezed off the 100, we pushed to this peak, and then we rolled back over. Didn't see it at the time. Same sort of pattern has followed in a lot of different sell-offs over the years, going back to COVID. But that was significant, that push off that 100-day moving average, and then the rollover. So there was selling, there was a pop, and then funds used that period to exit. There was forced selling that started in March, and then we get into oversold territory at the period where the quarter ends, and there's going to be rotation. Well, that's sure enough what we see. We see from oversold, buying starts, and it's a very quiet bidding period that takes us up to April 6th. And this is important. April 6th is important because, as I say, a lot of focus is around that 20-day moving average, EMA 20. Okay? That is very critical. It's critical because that is where a lot of algos step back in, where a lot of buying patterns step back in, and where momentum can move very quickly off of oversold territory because we have a very slower, lower volume move back to this level, and then it takes off. On top of this, which is also very important to note, there were a number of other signals as well. Momentum starts to flip, and I've talked about this strategy. It's very simple. All you have to do, if you need a compass for the market, take all of the stocks on the S&P 500, 503, but remember, Google's listed twice. Go to the fundamentals. Forgive me. Go to the technicals. Go to your beta of 1 to 2. That's it. Beta 1 to 2. Performance. Stock up on the month. Performance. Have to customize it. Stock up on the week. +5. Okay. That's going to give us 44 stocks right now. Okay. 44 stocks are up 5% up on the month. And I'm not saying up 5%. I'm saying they're just up on the month. Beta 1 to 2. Okay. So a higher beta than the actual market. That's important. Now, here we go. -5. We're going to flip it the other way. Monthly down. So you have 44 stocks in those weekly above 5% up on the month showing, an increase in the stocks. So there's not a lot of noise here. And 4 on the downside. It's very comparable to this number, this equal weighted number. Now, the equal weighted number is a little bit higher because we're actually going into individual sectors and doing different types of analysis based on breakout conditions in those sectors. But this is important. That is just a poor man's way to measure momentum. And that momentum switch happened April 7th. Okay? So that's the poor man's way. In addition to this, we see this with the SPXL. We see a momentum move above the 20-day moving average. We see the FNGD, which I talk about all the time as a leverage gauge, break down under its 20-day moving average on April 6th, April 7th. In addition to that, we see moves on things like the FAZ, which is the bearish ETF around banks under the 20-day moving average on April 6th and 7th. Do you see the pattern? And sure enough, our signals flipped right around this time. Okay, especially the Russell. So our cap weighted number, which is going to be adjusted today, but the cap weighted number was pushing in that direction. April 6th, April 7th. There is your positive move on cap weight first time that day. We moved green the next day. That was the headline. And I'll tell you, I didn't trust this rally, but here's the problem. And here's the real lesson of the story of what came in. This is from Goldman. And that article comes out on about the 8th or 9th. And it is a reminder that commodity trading advisors bought or were set to buy, positioned to buy roughly $45 billion in equities in this week that has just transpired, and 34 billion of that concentrated in the S&P 500, which would be the second largest buy on record. Okay. And again, CTAs are a broad commodity category of systemic rules-based funds that trade across equities. When we are breaking down in momentum, they had got to sell. And they sold first week of February, second week of March. They sold because they had to. They're not making discretionary calls. They don't care what I think about Iran. They're only responding to price. Those are the rules. And you're talking tens of billions of dollars in flows in very quick periods of time in a relatively lower volume environment, which can lead to very pronounced moves. That's what happened. Okay. So now we know that, and it's a reminder. And it's a reminder for me to do a even better job, right? Much better job to focus on, okay, I have a negative signal. What needs to happen next? I need to start paying attention to what are the CTAs doing? And it's not like that information's not available. We see it. Zero Hedge writes about it constantly. Again, the Zero Hedge writing on CTAs the first week of February aligned with our signal move. Same thing in March where there was that selling. So as you can see, that forced buying is important. There was dealer gamma flip. The dealers went from their short gamma, so their selling begets selling. Too long where buying creates buying. It is a self-licking ice cream cone. It is the widest gamma spread on record, or at least that was the article that was noted from their desk. The short squeeze, big moves in high short squeeze stocks. I mean, look at Avis, for goodness sake. Avis stock is gone parabolic. And you have to explain to me once again why anybody is buying the stock in the first place, right? Look at Avis, AVIS. This is what has happened. Come on, there you go. Woo, that's fun. That's a good time. Are they an AI company now? This looks like it's going to be the short of shorts when it comes. All right, so now you see, now you understand how we got here, why it matters. Now let's actually start to focus now on what the market does now. Because again, we're still bearish on private credit, treasury borrowing, global liquidity, the refinancing cliff. It's all still there, but these moves have happened, and they happen often. They happened in 2008. They happened in 2022. They happened in 2020. They happen a lot. Right? It's just that you have to understand the mechanical nature of this. So once again, this is not about sentiment. This is about flows. And now that we're pushing toward overbought, this is where the warnings now start coming in. So Goldman and Nomura both flagging the same thing. The rally is real, but it's very fragile. So Goldman's Tom Shea saying time to fade the rally. You moved too far, too fast. Too fast. You took too much. You took too much. Two risk scenarios, re-escalation or stagflation, are back in play. The S&P 500 sold 9% and then ripped 10% back. And these are the types of rallies that I've talked about. This happened in 2020. It happened in January 2020. It happened in March 2020. It happened in June 2020. And then all of a sudden, hedge funds would sell off. So we have to pay very close attention to technicals like relative strength index. We have to pay very close attention to our signal. Our signal goes negative 3 days in a row or just starts selling off 3 days in a row. That's a warning sign. And if you are part of this rally, if you did do well, if you paid attention and you were, following some of the same rules and tools that we've discussed in the past, then you might start thinking about hedging your positions, meaning you sell calls to the upside. If you have a stock that's at $50 and you have an opportunity to sell a call for, 55, $60 out 2 months, you might consider that, because the worst case scenario is stock goes up another 10, 20% and you take profits because the stock went above the call. Some people don't want to do that because they're worrying that maybe the stock will go from 50 to 70. But if you've been in the mindset for a long time that, hey, now is the time after this type of rally into overbought to consider new different types of strategies to generate income and set your expectations. Hey, I've got a $50 stock. I'm more than happy to sell it to you for 60 if I bought it for 35. It's kind of how the market works. All right, but that said, May 6th expiry, S&P 80% of the S&P 500 earnings coming up, plus the FOMC and the non-farm payrolls. They're suggesting to go the opposite direction. And this is an entry point for cross asset hedges now. And you're going to start to see hedging happening now. It's not going to be at the retail level. It's going to be at the institutional level. Now, Nomura, okay, biblical vol re-rating, overhedged for chaos, put destruction, and delta chasing. High SI baskets, 9% to, again, short interest to 17% in 5 sessions. Mega cap is doing all of the heavy lifting, and that's showing up in our reading that we have over at Money Printer Pro, right? What is that signal telling us? What is it telling us? Well, if you look at the cap weight, 191, it's telling you that the largest stocks are leading the S&P 500 higher. They're responsible for the overall S&P 500 bigger move. When this cap rating is below the equal weight, that's telling us that more stocks are moving higher, but the mega weights are likely under pressure. And that's why when you do that poor momentum reading, you want to check things like the FNGG or the Mag 7 stocks, because if they're squeezing higher, if the S&P 5, if the number of stocks breaking out is higher than the number of stocks breaking down, but the FNGG is still under key moving averages, it's telling us that the market is not, it's not the mega cap stocks doing it. It's the smaller cap stocks. And that can be problematic because if those mega cap stocks continue to sell off, the broader S&P 500 will still face pressure. But when the cap weighted number is higher than the EW, it's telling you those stocks in the top 100, top 50, top 20, top 10 of market capitalization are really doing all of the work in this market, and that there still is a lot of weakness persisting that people aren't paying attention to. And I have talked a little bit about this because, once again, if we dig a little bit deeper, it's all still there in our data sets. We still see it. We still see within our conviction zones, within all of the stocks in the S&P 500, that there still is weakness down at the bottom. Names like Progressive and Aon and Marsh and Willis Tower and Ares. Those stocks are still under pressure right now because the problems in private credit, concerns around real estate, concerns around insurance, and things like S&P Global, they haven't gone away. And these things can and will persist for longer, even though the war dominates the headlines and the rally is now on page 2. These problems are still here. Okay. That said, Nomura also saying May physical energy gut punch, looking at a macro tail risk, looking at the possibility of this is going to continue to compound across markets. We're going to see if the United States exports are going to be able to alleviate it. There's a lot of questions still ahead. So again, very high focus on the mega cap names, big focus on the tech names. That rally has persisted. But once again, you have to keep an eye on these key moving averages as we move. All right. Additional things to discuss real quick. TSMC raising its roof, revenue up 35% year over year, operating profit up 61%. This is telling us, once again, the AI trade is real. It's still there. It is a question of when it will stop, right? Everybody's looking for this thing to slow down. It ain't slowing down. And I'll tell you right now, one of the projects that I'm working on, demand for AI data centers is unbelievable right now. One day you're waking up and you're going, well, which project do we choose? What partner do you choose? And then you have to make the tough decision. And then all of a sudden you get 4 phone calls from people saying, hey, is your project still available? The demand is still accelerating, and it's going to continue to accelerate. And the reality is this: there is going to obviously be the concern around consumer spending and what is transpiring with the electricity costs in the regions, but it's full steam ahead for now. And this can persist for some time. We're obviously looking for a break at some point out of names like NVIDIA and TSMC. But the reality is this is a train that you don't want to try to get in front of. It just continues to showcase time and time again that demand is real and the margins are real and the trade is real. This was another story that I thought was really important to note. And this comes from Morgan Stanley. Oh boy, where do we even begin with this guy, right? All right. So Morgan Stanley has come out and has said, and this is going to be one of those stories that I really want to focus on in the next couple of weeks. This comes from Morgan Stanley's CFO saying something remarkable. She asked, "How do you think of a tokenized world?" Mm. This is the CFO of one of the largest wealth management platforms on the planet asking that question publicly. Morgan Stanley is currently piloting with Zero Hash to bring tokenized assets onto their wealth platform. MicroStrategy's Bitcoin ETF, the MSBT, is up 8% this week, and Amy Oldenburg was just named their head of digital assets. BlackRock's BUIDL fund is growing. JP Morgan's Onyx is processing billions in tokenized repo. And this is not crypto hype. This is the plumbing of finance being rebuilt right now. So tokenization makes assets programmable, transferable 24 hours a day, 7 days a week, fractional and transparent. And it's collapsing settlement from T+2 to T+0. It's the biggest financial institutions in the world are building all of this right now while we're all distracted by a war and everything else going on in the world. Okay. Remember, it wasn't too long ago that everybody was calling this stuff rat poison and saying that it was not something that they wanted to touch, but they allowed all of the crypto bros and libertarians of the world to build the infrastructure, and then they just basically figured out a way to take it all over. And they did. And now you're seeing the possibility and the flow and the expectations of the shift in how assets are going to be collateralized and how that may impact positively the S&P 500 and the broader markets. Need to really dig into this, but this is the brave new world that we're walking into, and there's a lot of regulatory fog around this. The SEC hasn't issued clear guidance. There is obviously custody risk. Who holds the keys of all of this stuff? And bankruptcy, which is a big problem. Liquidity illusion. Tokenized does not mean liquid, and the secondary markets can run thin and there can be redemption mismatches. They're just going to rebuild the entire system and not really explain it too well. This is a lot of creative space, but creative doesn't mean regulated or safe. This is where we're heading. All right, so the market's still tiny, low billions versus hundreds of trillions in traditional assets, but the direction is clear. Tokenization is coming. The timeline is not. This could take 2 years or 20 years, but don't confuse inevitability with, well, imminence. The reality here is, again, on-chain permanent record, client data, regulators and hackers are both watching. This is the future of the market, right? And the reality is we're going to dig deeper into this in the months ahead, and we'll have a couple of reports on this at some point. The key thing here is this will, even if you're not a participant, this is where ultimately a lot of this work will be done. There's a lot of regulatory focus on this at the moment. It's very clear that Scott Bessent and company are pushing in this direction. The institutions get it, but we don't. And we have to dig in further to understand the counterparty risks, but also the opportunities ahead. And there are quite a few. On the Japan side, well, we're back at this story once again. Put 158 on the screen because that's where the dollar yen's trading now, 158 yen to the US dollar. Citi's latest research says that if the Bank of Japan holds rates at its next meeting, and the market expects them to hold, the US dollar and the JPY will move to 160. At that point, there is some expectation that there could be an intervention at the 160 line to try to get us back to 155. All right. Their finance minister in Japan told the G7 this week that there is a high sense of urgency. Finance ministry official Mimura is coordinating directly with Treasury Secretary Bessent on this. The euro yen cross just hit a new all-time high. The yen is weak now against everything. So the Bank of Japan is boxed in. Raising rates is going to kill the equity rally. It's going to impact the cross-border flows. It's going to impact the carry trade. Remember, we saw this transpire back in August 2024. If they hold, the yen is going to likely continue to fall. Inflation will pick up and they will be forced to intervene. But either way, the world will feel this. And I go back to what I wrote about last year, the carry trade bomb in the BIS context. Okay. They talked about this. They talked about it last summer, and they noted that Japan's carry trade unwinding can crash U.S. markets very quickly. The Bank of Japan raised rates in August 2024. The yen carry trade unwound. The U.S. felt it right away. And the BIS said that foreign monetary policy spillovers are now, quote unquote, comparable to domestic policy. So any action that the Bank of Japan takes will impact equities here. It will impact bond markets here. It will impact capital flows here. This is very important. This means that the Federal Reserve is not independent. Your neighbor's thermostat controlling your house. I've made that analogy before, that 30 years ago, your temperature in your neighbor's house did not impact yours. Now, if you were to make the comparison in monetary policy, if they dial that thing up, it impacts you directly. All right, so hedge funds hold more than 10% of the Treasury float. That's important. 70% of bilateral repo is at zero haircut. That's important. The dollar stopped being the safe haven roughly in April 2025 of all of these trades, largely because, again, that was the trade issue. That was where we saw stable coins becoming the larger buyer of Treasury bills. And that is on par with a lot of the money markets. They're getting creative with where the dollars and where the treasuries are being purchased. If 160 breaks, Japan will intervene and the carry trade can and would unwind. Pay attention to that because treasury volatility can spike, repo stress can start, and there could be a forced central bank response. That is a chain reaction that we have talked about. And don't tell me that it won't happen because it's already happened multiple times. We just keep seeing policy intervention time and time again, like we saw with Japan and their stimulus back on November 21st. All right, endgame strategy for the war. Final components before we move on with our day. Pakistan's army chief is traveling to the U.S. to speak to leaders here on Friday. Iran and Pakistan are discussing U.S. proposals today. A Lebanon ceasefire is expected soon. The architectural of the deal is forming slowly, but the friction is pretty clear. Iran says that it is ready to sink U.S. warships. The nuclear file is still unresolved, which is problematic. Hezbollah has fired at Tel Aviv. A journalist covering the talks says that there's far less positive than reported. 6,000 U.S. troops are now inbound, and official optimism and ground level friction are the stories beneath the surface. As we move into this morning, pay attention to Allbirds, which went up, 580% because they pivoted to AI, a tennis shoe company or a sneaker shoe company or dress shoe. A shoe company is now an AI company. That's where we are. NYSE, another AI company. Magnet moving 100% on a rebrand. Robinhood jumping 10% on SEC regulatory relief expectations. Snapchat getting a big bump because they, laid off 16% of their workforce thanks to quote-unquote AI efficiency. TSM and Tesla both in focus. Microsoft getting a bid. AI disconnected sell-off becomes a buy according to Ives. And Lam Research is the outlier that is down pre-market versus its semi-peers. Today, once again, you want to pay attention to Abbott, Schwab, Pepsi, Consumer, and Rates, and that GLP-1 check. Pay attention to what Williams says at the FHLB New York session. Moran will provide an update on global outlook, and Warsh's probe will be ending soon. Tomorrow, I believe the blackout starts for the Fed's next meeting. Again, Japan matters. Citi talking about the BOJ and the 160 level. Very critical to keep an eye on that. Pakistan's army chief comes to the U.S. tomorrow, and we are looking at proposals. Basically, at the end of the day, Goldman saying, fade it. The VIX skew is screaming. If you want to be paying attention to this, look at the 1 hour charts on the UVXY. The UVXY starts to move higher. Your cross trade is shorting the S&P 500, but doing so only for the duration of any spike in the VIX. All right, that was a long show, but worth every second of it. If you have any questions, you know where I am. Also, you can check us out at Insider Buying Report and InsiderStockBuys.com and check out the latest insider purchases. We got a couple today from Lamb West. We've seen some nice buys out of Nike as well. We'll make some recommendations tomorrow for our Insider Stock buyer audience. In addition, Money Printer Pro is available, and our site, obviously, we had 1 day of maintenance, got everything back in check. with our updated figures. You want to pay attention to that. Obviously, if we see a pullback, screamers and crashers, everything updated, ready to rock and roll. So just go over and click the link for a discount. Finally, Postcards from the Edge of the World will come out on Sunday. We had a recent report that basically recapped everything that we have been talking about for the last couple of months. That portfolio is beating the S&P 500 since its inception in December. All right, everybody, have a great day. Stay positive.